Hello. My name is Alan Tran and I'm the founder of Haiku Trading. Today, I'm just making a video around the misconception that Robinhood has been stealing people's shares. Just a quick disclaimer, I am not affiliated with Robinhood, and this is not financial advice nor a signal to buy or sell any stocks. Please, this is just stock education. Take it all with a grain of salt. And as always, don't forget to like this video and subscribe. So I'm sure you're wondering, if you're watching this video, why did Robinhood steal your shares? Well, plot twist, Robinhood didn't actually steal your shares. So what happened? If you have less shares than you remembered, you could be facing one of these three scenarios. One is your cover call option contract was exercised and you sold increments of 100 share lots. You were plastered drunk and you happened to sell your position. Or the company that you are invested in is participating in a reverse split. If you're watching this video, most likely your shares went through a reverse split. So what is a reverse split, you ask? A reverse split is an accounting trick utilized by primary stakeholders that decrease the amount of overall outstanding shares while proportionally increasing the value of the underlying equity. So to honestly put a reverse split into simple terms, the amount of shares go down as the share price goes up, and this is a decision made by the executives in an organization. No money is lost or gained in the actual action of the split. So let me show you two quick examples of how reverse splits impact both a whole organization as well as how it impacts your personal portfolio. We will be using company XYZ as an example on how a split impacts an entire organization. Company XYZ currently has 100 million outstanding shares. These shares are currently trading at 50 cents a share, and company XYZ's shares are currently under the $1 minimum required by the NASDAQ. Company XYZ announces that they are going to have a 10-for-1 stock split. Company XYZ has 100 million outstanding shares at 50 cents a share. This means that the market cap for XYZ is $50 million. The 10-for-1 stock split gets approved, and the number of outstanding shares is divided by 10, while the value of the remaining shares are multiplied by 10. XYZ used to have 100 million outstanding shares at 50 cents a share with a market cap of $50 million. Now, XYZ has 10 million outstanding shares at $5 a share, still with the same market cap of $50 million. Shares and share prices have changed, but the value of the organization has remained the same. Honestly, this concept is very easy to understand, and I hope you're able to conceptualize it by now. If not, don't worry, I'm going to show you how it personally impacts your portfolio. So you decide on purchasing 100 shares of XYZ for $1 a share. XYZ drops to 50 cents a share. You're down 50% on your position. XYZ announces that they are going to offer a 10-to-1 reverse split. Being confused, you click on this video. So XYZ's 10-to-1 reverse split gets approved. You have 100 shares with a 50-cent value prior to the merge, and now you will own 10 shares of XYZ at $5 a share. The price you paid for each share is $1, and now each share is priced at $5. So, you should be up a bunch of money, right? You're actually wrong. Your average price per share is $1 pre 10-to-1 reverse split. The average price of each share is also multiplied by 10. So your average cost per share is $10. That means you are still down 50% on your position. I hope this was a very simple explanation of reverse splits and how they impact your position. So how can you protect yourself from companies that do reverse splits? First is stop playing companies that are currently trading around the $1 mark. This is the minimum threshold to have a publicly traded company on the NASDAQ. A lot of companies will have reverse splits just to assure that they are above that $1 threshold. Stop blindly investing in companies you have not done research about. There's a lot of companies out there that are simply there to steal shareholders' money, and a lot of these reverse splits happen from these types of organizations. And last, check if the company has had any previous reverse splits. You can tell very easily if a company is going to have any future reverse splits by checking on their history. If it happens often, it is most likely going to happen again. I hope you've learned something from this educational video, and as always, don't forget to like this video and subscribe. Comment some more educational topics that you'd like to see below. I hope you have a great day. Take care.